Welcome to this Killik Explains finance video. This week, 5 big calls that stock market timers rarely get right. None too subtle hidden message is don't try and time the market. But I'll try and convince you as to why. Now I've covered this in other videos, but specifically, let's look at all the things that have got to go your way to get market timing right and the reasons why people don't. So the background to this is what? Market timing is tempting, particularly if you see the stock market wobbling. You're thinking, oh crikey, let's bag some gains, let's go to cash, let's say sell all our stocks and then wait and get back in when things look rosier. Sounds so simple, but it requires 5 separate judgment calls. Now I've covered this from other angles in other videos, but this is just to point out how many things you've got to get right. And I'm going to suggest that most of us, me included, are pretty unlikely to get them all right. We're going to get at least one of them wrong, and even one of them going wrong can basically stuff up your cunning market timing strategy. So the big 5, what are they? You have got to be able to predict what will happen and when. Now hindsight's a wonderful thing, don't forget. So predict in advance what will happen and when. Judge the impact on the economy and the markets. And I use those 2 words separately for a reason. The economy and the stock market are not the same thing. All right, and I've done videos on that. So predicting the impact on the economy and predicting the impact on the stock market, pretty tricky. So there's like 2 calls in one there. That's just number 2 of 5. Act quickly enough to benefit. Because don't forget everybody else. People think they're acting in isolation when they're at home on a laptop or whatever. Everybody else is trying to do the same thing. Some bigger, better, faster brains than yours, I would suggest, might be out there trying to time the market. Decide when to reverse course. So let's say you think, yes, I got out sort of around the peak. That was great. When do you go back in? And bear in mind that some of the best investing days, unfortunately, occur just after the market's dipped most heavily. And you've got to be able to gauge the long-term impacts. And actually, is this an event that's a one-off, a short-term problem, or is this actually symptomatic of a longer-term decline? In other words, maybe I need to rethink my asset allocation. All right, this is not just a market timing call, but that's a rather different beast altogether. So there you have it. Now, naturally, it's exceedingly difficult to get all 5 steps right. Don't take it from me. Adam M. Grossman on Humble Dollar said those exact words. And by way of illustration, let's take some big, seemingly obvious calls by way of illustration. So here's one, the 2016 US election prediction. Everyone knows what happened, but at the time, far from it. So at the time, 9 out of 10 polls predicted a Clinton victory. And obviously you can say, well, I know what happened. I know, but at the time, that was reality. Many predicted a stock market crash, a monster, all right, and world recession should Trump prevail. And Goldman Sachs, no less, one of the most preeminent investment banks in the world, forecast a specific 25% peso slump on the basis of the rhetoric Trump was using around the wall and Mexico and so on. So, those were the forecasts. What actually happened? You say, well, I know what happened, but yes, it's worth refreshing. Trump won. The stock market has gone up around 30% since. Now it's wobbling, it could go back down again, but up 30%. The US economy is showing some great signs of life. You've got to be honest, that could change, but the US economy looks reasonably robust. Stock market has basically risen, and the peso has been essentially flat since 2016, wrong footing, one of the best economic think tanks in the world. So it just goes to show. Now you might think being at the heart of things would help, so let's follow the people who are at the heart of things. Well, I'll just give you one illustration of the fact that that is wrong. So the guy who won, Donald Trump, 8 months after appointing Jerome Powell to the Federal Reserve, said, I don't know what their problem is that they're raising rates, and it's ridiculous. The Fed is going loco, I'm not happy about it. So the man who actually appointed the person responsible for US interest rate policy didn't seem to have a clue where they'd go and how fast. So a better bet. So we're not going to try and make those 5 difficult calls necessarily, so what do we do? Well, I've covered this in more detail in other videos, so a quick summary here, very quick. Long-term portfolio management is the key. There are 3 prongs to that at least. One is getting your asset allocation right. So, making sure you are correctly allocated in terms of stocks, bonds, property, cash, and so on. Alternatives, if they're appropriate, and they're not appropriate for everyone, I cover that in another video. Diversifying within asset classes. So that won't protect you if the entire stock market crashes, but it will at least protect you from single stock risk and so on. And liquidity planning. Not putting yourself in a position where all your eggs are in the illiquid equity basket or bonds basket at a point where you need to retire, liquidate money, liquidate funds for school fees, and so on. So it's planning is the key, not trying to be clever about market timing. Plenty of ground covered there, so editor@killik.com if you'd like to know what some of those other videos were, and it's killik.com/learn for those videos, or ping me if you're not sure where to find them.